Hi everybody and welcome to this theory video which will talk you through revenue curves but then also introduce profit. So there are three different types of revenue that you need to be aware about: total revenue, average total revenue and marginal revenue. Now all total revenue is calculated by the selling price multiplied by the quantity sold. To work out average total revenue, all we do here, we look at total revenue and we would divide this by quantity sold. Marginal revenue, probably the most difficult one to calculate. We would look here at the change in total revenue divided by change in quantity sold. Okay, so marginal revenue, it's the additional revenue generated by business when they raise output by one extra unit. So change in total revenue divided by change in quantity will give you that formula to work it out. Now, the best way of understanding this, though, is to show you a numerical example. So we've got here a business that is charging different prices for a product. So £10 all the way down to £3 for this particular product. Try and think about quantity as the quantity being demanded at these different price levels. So what we would have expected and what we always generally see through demand is that when you lower the price, there will be an extension in demand. So if those want to raise demand for their products, they will often lower the selling price. So you can see that when this business lowers price from £10 to £3, demand will extend from 1 all the way to 8. So remember, total revenue is simply calculated by price multiplied by quantity sold, which in effect is the demand. So at £10, the total revenue will be 10, which is simply 10 times 1. Now at £9, both consumers, the original consumer that used to pay £10 and the new one, will now pay £9. So 9 times 2 will be 18. At £8, we're going to have 3 people buying, so total revenue will grow to 24. At £7, we're going to get £28 worth of revenue. At £6, we're going to have 30. At £5, there will also be 30. And look what happens now. Something strange will start to happen now. Total revenue will start to actually go down when we lower the selling price to £4. And then it will go down again when we lower it to £3. Now, we'll understand why this is happening when we think about the marginal revenue curve. Now, average total revenue, again, all we would do here, we take the total revenue and we divide it by the quantity. Now, it's worth noting at this point that average total revenue is simply the demand curve. It's measuring the price and how that will influence the demand. So if we were looking at £10, well, the average total revenue is 10. It's literally total revenue, which is 10, divided by the quantity sold, which was 1. So the idea is here, everyone, the average total revenue will always be equal to the selling price. And then when we plot this, it will also be equal to the demand curve for the business. So I'm just going to copy down these price numbers here. Now, if you don't believe me, think about what you would have for £4 to work out the average total revenue. You take the total revenue, which is 28, you divide it by the demand, which was 7, and it will give you £4. So average total revenue is literally equal to the selling price. Now, marginal revenue is just how much revenue will grow by when we sell an additional unit of output. Now, you'll notice, everyone, that the first unit of output, when we charge £10, we're selling 1 unit of output. So what we've got to assume is if we sold 1 less than that, there'd be 0 total revenue. So from going from 0 to 1 unit of output, total revenue has grown by £10. And when we go from 1 unit of output to 2 units of output, total revenue has now grown to £18. So it's grown by an additional £8. When we go from 2 to 3 units of output, we've had to lower the price from £9 to £8. Revenue grows by another 6. When we go from 3 units to 4 units of output, revenue will grow by £4. We've then got £2, then it's 0 when we charge £5. Then when we sell an additional unit of output beyond this, it now actually falls to -2, and then it will fall further by £4 when we go from unit of output 7 to 8. Now, it's worth noting at this point here what is happening here. Now, the reason why marginal revenue falls away at a much quicker rate than average total revenue is that when we lower the selling price to raise the demand, it's not just the new customer that is getting the new lower price or the marginal customer, it will be the original customer as well. So by lowering the price to entice another person to buy the product, the original consumer is making a bit of a saving. So we do gain some revenue by having an extra customer, but we will lose a little bit of revenue by having to give the original customer a discount as well. So when you think about it, everyone, to entice the eighth customer into the market, we've had to lower the price to £3. Well, marginal revenue is now negative. So although we get that £3 from the eighth customer, we're losing revenue on customers 1 through to 7 that were originally paying a higher price than this. Okay, so marginal revenue will eventually start to become negative. Now, there's another interesting point on this table as well. When MR equals 0, the business will maximize total revenue. So when MR equals 0, we maximize total revenue. So this point here is called revenue maximization. So that will occur when MR is equal to 0. So what we can now do, we can now think about this by looking at some different graphs. Now, to try and speed things up a little bit, I've already plotted the different points for these different curves that I'm going to draw. Now, in this top graph, I'm going to use this data to plot average total revenue and marginal revenue. But then directly below this, I'm then going to plot total revenue on a separate graph. And I'm going to use this to illustrate revenue maximization for you. So what we're going to plot first of all are these average total revenue curve points. Now remember, average total revenue is measuring the demand curve, but it's also measuring the selling price. So you've got here a normal downward sloping demand curve. We've got a negative relationship between price and then demand. As price levels falls, we're going to get an extension in demand. So for example, at £10, we only had one person buying, but at £4, we would have all the way out there to 7 people buying this product. Right, now we're now going to plot the marginal revenue curve. Now remember, this one will fall away quicker than what average total revenue will do. And the rationale for this again was that when we lower the selling price to raise the demand, the original consumers are also getting that new lower price. So we do lose revenue from those original customers that used to pay a higher price. What I'm then going to do directly below that is to plot how total revenue changes as we lower the selling price to raise demand. Now look what happens, everyone. And I'll put this on the graph. Remember, when MR equals 0, we call this revenue maximization. It will always occur when MR is equal to 0. So we can see at this point here that when marginal revenue becomes negative, total revenue will eventually start to fall beyond that point there. So we can see this business will maximize revenue at £30. That'll be the amount of revenue the firm generates. After this point, total revenue will start to fall. So look at that then, everyone. Originally, when firms lower prices, they will see total revenue grow as they lower the price. But then after MR equals 0, any additional reductions in price will see total revenue start to fall. Now, I can now add something else to this diagram as well. Now, what we can do, we're going to extend up this point here. And we're going to look at the demand curve. Now, what we're going to find out is that this section of the demand curve is actually going to be price elastic in demand. Then this section here will have a price in elastic demand. And we're going to be looking at some numerical examples to prove why, and then we'll start to think about what is happening here and why this is actually happening. Now, clearly the red blob in the middle would show price unitary demand. Right, so let's think first of all about this point here. Now remember what we said. on the top section of the ATR, or the demand curve, the demand will be price inelastic. Now, if you remember, to calculate price elasticity of demand, you've got to use the formula percentage change in demand divided by percentage change in price. Now, what I'm doing here, I'm going to be lowering the selling price from £10 to £9. Now, when this happens, the demand for this product goes from 1 to 2. And look what we get then. When we lower the selling price from £10 to £9, that is a 10% reduction in selling price. So all we do there, we do the difference, which is -1, divided by the original price of 10 and multiplied by 100. The demand's gone from 1 to 2. So the demand has doubled in effect. Now, if I put that into the calculator, I get a score of -10. And if you remember, anything that comes between -1 and -infinity from that formula would show price elastic demand. So what this means here then is that demand is unresponsive. It's very responsive to that change in price. So I'll reiterate that again. Demand is very responsive to a change in price. Now, what we can also see then, and this is something we always recommend for firms when demand is price elastic. When demand's price elastic, if you lower selling price, it would raise total revenue. And that is because the percentage increase in demand would exceed that percentage reduction in price. So overall revenue would increase. The revenue gained would exceed the revenue loss for the company. Okay, now the reason why demand is price elastic at higher prices is because of the percentages. We're going from a low demand to a slightly higher demand, but when demand is very, very low, an increase in demand will be a significant percentage. But also another way of thinking about it is at high prices, it's a bigger proportion of your income, which makes demand more responsive to a change in price when price levels fall. Now, in this example here, we're looking at a price inelastic demand. So when price is really, really low, what we would say, well, demand here will be inelastic, mainly because demand's already quite high based on this demand curve here. So an additional increase in demand will be a low percentage, but also this product will form a very small proportion of people's income. So a drop in price will be a smaller percentage reduction in price than what it was when price was £10. Now, anyway, what we've done here, we've lowered the selling price from £4 down to £3. And that has raised the demand from 7 all the way up to 8. So look what's happened now then. We've now got a 14.3% increase in demand. It's gone from 7 to 8. So the difference is 1 divided by the original 7 multiplied by 100 will give us a 14.3% increase in demand. A reduction in price from £4 to £3 is a 25% reduction. If I put these numbers into the calculator, I get a score of -0.57. And if you remember from the PED calculation, anything between 0 and -1 would show price inelastic demand. So the percent change in demand here will be less than the percentage change in price. Demand is unresponsive to that change in price. Now look what would happen here then. If we lower the selling price here, then total revenue will actually start to go down. Okay, that idea that the revenue gained from additional customers will be less than the revenue lost from all the customers that are now paying a lower price. So marginal revenue is now negative. So reductions in price would reduce total revenue. Now let's now draw these diagrams then, minus the numbers. So if I was drawing these freehand, what I would draw is this. So I've got average total revenue, which is equal to demand, and it's measuring the selling price. I then add marginal revenue. Now the interesting point here again would be that when MR is 0, we maximize revenue. It's where total revenue will get to its highest possible point. We go beyond that point, and total revenue will start to go down. If I extend up the revenue maximization point, which is where MR equals 0, we can see this section of the demand curve here has got a price elastic demand. This section will be price inelastic demand. And then again, think about what this means. If demand is price elastic, it means that demand is very responsive to a reduction in price. So the percent change in demand would exceed the percentage reduction in price. So this would lead to an increase in total revenue. The revenue gained from new customers would exceed the revenue lost from customers that were buying anyway, but at a higher price. But then when we go beyond revenue maximization, demand becomes price inelastic. So reductions in price this time would lead to a reduction in total revenue. Okay, so the revenue gained from additional customers would be less than the revenue lost from existing customers when we reduce price here. Right, now what we're moving towards now is thinking about profit. So we're going to combine revenue and cost curves together. Now, as a reminder, profit, it's total revenue take away total costs. So all we've got to do to show profit in a diagram is to combine cost curves and revenue curves. Now, if I was thinking about short-run production, remember, marginal cost will take on this shape here. So originally, marginal cost will fall as output expands due to increasing marginal returns. But then it will start to go up because of diminishing marginal returns. And we then draw our average total cost curve. Now, remember, everyone, MC equals ATC shows productive efficiency. It's where the firm operates at lowest average total cost. MC will always put ATC at this point because before this point, marginal cost is below average total cost. So on that arrow there, ATC is always above marginal cost. So as output expands, the marginal costs are less than the average, it sucks the average down. But beyond productive efficiency, on that second arrow, marginal costs are now above average total costs. So raising output beyond this point will create more marginal costs than the average. So it sucks that average cost back upwards again. And then when we draw revenue curves, the two in question I want to be thinking about are going to be these two. So I've got marginal revenue, and then I've got the ATR curve, which is also measuring the demand curve. Now, what we're going to be doing is to be combining these two different sets of curves together to show profit. So, as I said before, profit is total revenue take away total costs. Now, of course, it could also be calculated by looking at the average total revenue take away the average total costs. That would almost give me the profit per unit, if you like. Right, now, another point that's worth noting as well, that firms will always maximise profits when marginal revenue is equal to marginal costs. Now, I'm just going to start off by adding the marginal cost curve and then adding the marginal revenue curve. Now, remember, profit max will occur at this magic point here. So let's call that Q star. Now, think about why. To the left of that green blob there, marginal revenue is above marginal costs. So that means the revenue gained from additional units of output exceeds the cost created by producing and selling additional units of output. So when marginal revenue is above marginal costs, it's going to be contributing towards higher profits. But then when we go beyond that green blob, the marginal costs exceed the marginal revenue. Well, that would mean that additional units of output now are creating higher additional costs than what they are additional revenues. So that will start to see profits start to fall. Now, to show revenue, I'm now going to add the average total revenue curve, which again is the demand, but it's also the selling price. Now, that therefore means that when firms identify where their profit maximizing output is, they will extend up this green line to get the selling price. Okay, now look at that then now. The area P1, A, Q star 0, it shows the total revenue of the business. But there's a saying in business, revenue is vanity and profit is sanity. So we've now got to add the average total cost curve so we can work out the costs for the business. Right, now I'm just going to draw this average total cost curve in a particular way. Now I'm still observing the rules. So ATC will bottom out when it cuts marginal cost, but then it will start to go back up again. Now look what we can now do. What we can now show then is that when the firm operates at Q star, the average total cost of production will be at point B. If I multiply that by the quantity produced, then I'm going to get this red rectangle here. So let me just label this down. So C to B to Q star to 0 would show the total costs. Now think about what that means then. This firm is generating profit equal to this green shaded area here. So that is the revenue above the cost of production. So we can see here the profit that is generated by the business. Now everyone, what us economists like to do is to make things really, really complicated. So what we've got to be aware of is that there's different ways of thinking about profit. Now this top one is the one that I've just drawn in the diagram. It's where average total revenue exceeds average total costs. So in the diagram, we can see here, if I go back, average total revenue was at A, average total cost was at B. So we can see here then that the total revenue, so if I multiply these averages by the quantity, I can get total, that the total revenue would exceed the total costs. So the firm would be making super normal profit. Now, a good way of thinking about what we mean by this is to think about the next one, which is normal profit. Now, business people, normal profit, you're probably thinking, well, that's just break even. If we multiply the average total revenue and the average total costs by the quantity, we're going to get total revenue and total costs. If these are equal to each other, well, you're breaking even. Well, us economists would still call this profit, because remember that when business incur costs, they've got to pay for the facts of production. So those inputs into the production process are things such as land, labour, capital, and enterprise. So what the owners of the business will do, they will factor into the cost of the company what they would deem a satisfactory return for themselves. Okay, so when you create businesses, you've got risks. So you want to be able to generate incomes from those risks that you're taking as a reward for that risk taking. So entrepreneurs will factor into the costs a satisfactory return for themselves. So what they'll do, they'll work out the bare minimum they would expect income from that business to justify keeping their investment in the enterprise, and that will be equal to the opportunity cost. So equal to what they could earn by investing in a different type of business. So the idea will be that that there's no spare money left over. They're taking from the business what they deem to be the minimal acceptable return, and that will be factored into those costs of production. Now, if you're making supernormal profit, the owners are generating not just the minimum they would expect from investing in that company, but there is profits on top of that as well. Now, the bottom one, if average total revenue is less than average total costs, then we would just say you're making here what we call subnormal profit, which in effect is losses. Okay, so you're not even generating sufficient revenue to pay for all of your factors of production. Well, if this continues into the long run, then most businesses would decide to close down in this type of situation here. Now, we can then show these different types of profit in some different diagrams. So remember, if I was defining these different types of profit, supernormal is where ATR exceeds ATC. Normal profit is where ATR is equal to ATC. Losses is where average total revenue is less than average total costs. Now, just to make this consistent, I'm going to use the profit maximizing output point to show these three different types of profit. So I'm going to kick off by drawing three identical diagrams. So we'll kick off by drawing the profit maximizing output. So remember, profit maximization will always occur when MR is equal to MC. So let's label that profit maximizing output. So we'll call it Q1 this time. Q1, Q star doesn't really matter. Now remember, to work out the selling price, we've now got to add the demand curve or the average total revenue curve. So we'll now add this curve to the diagrams. And hopefully what you've noticed is at the moment, I'm just drawing 3 identical diagrams. So we can now use this to determine the selling price. And then, of course, this big rectangle we've created, based on the price and quantity, would measure the total revenue. Now, to work out profits, we've now got to add the average total cost curve. So what I'll do, I'll show here on the first one, average total cost curves going below the average total revenue curve. So look at that. On this first diagram, the profit maximizing output, the average total cost is below average total revenue. That means the firm here is generating that green area of super normal profit. Now I'm just going to go to the other extreme now, losses, where average total revenue is less than average total costs. Now all I've got to do here, draw the average total cost curve above average total revenue. Now I'm still trying to use this diagram to show the rules though. Remember, average total cost will bottom out when it crosses marginal costs. But look at this. So a profit maximization point, Q1, is the profit maximizing output, and the firm is charging P1. That's the average total revenue. But at this point here, the average total cost is all the way up here. So this red rectangle now is showing the losses of this business. Now, if this is the profit maximizing output, what we're really suggesting here is this is the output point where this firm would actually minimize their losses. Okay, so this is the point where losses will be at their lowest level. But this firm here is clearly making losses. Now, the one in the middle is the most difficult diagram to get right. What we know is, this black blob here, that is the average total revenue. So what I'll do, I'll draw the average total cost curve so it goes through that black blob, but it's the best that the firm can do. I'll explain what I mean by that in a moment or two. Again, ATC will bottom out when it crosses marginal cost, but then it starts to go back up again. Now look at that point there. This firm here, the best that they can ever do is to achieve normal profits. At every other point on that diagram, every other output point, the average total costs are above average total revenue, which would mean they'd be making losses. So you've got a firm here, everyone, that is making only normal profit. Right, everyone, so look at those 3 different diagrams, and super normal profit and losses. All we've done, we've combined those revenue curves from earlier on in the video with cost curves to show profits for companies. Right, I will stop there, everyone. So thank you very much for watching.